Thanks, darling, and a very warm welcome to you wherever you are in the world. Hope you're enjoying the, excuse me, just adjusting my microphone, apologies. Hope you can hear me okay. Just looking at Anna just to make sure. Yep, fine, good stuff. Okay, let's move that out of the way, move the chat box out of the way. Yeah, Randall, I answered your question in the chat. We would love to code all the indicators for TradingView, but unfortunately we're limited by the script available. It's not, doesn't have the functionality as MT4 MetaQuotes or indeed NinjaTrader or TradeStation, sadly. That may change in the future. We do keep an eye on it. We are looking at developing one of the indicators for it anyway, which has come about recently, but that's the reason why they're not there. So we can't develop currency array, currency matrix, and heat map. So at the moment, it's just the CSI. But we will always keep an eye on things. Right, okay, just on the, I've just got the indices up here, which is probably the place to start. As Anna said, you probably see it down here. Let's just pop this one up full size, it's the YM. The reason the volume down here is very, very out of kilter is specifically for that reason, because the breakers were triggered on all the futures contracts, or certainly on the indices contracts at any rate. They were triggered for quite some time because the market had fallen a given percentage, which I think off the top of my head is about 7%. And that was the reason that the futures markets were not trading this morning. They were closed, and they were closed for some time. In fact, they only reopened. This is UK time, so this is just after 1 o'clock as we get into 1:30, as the markets get underway, and the futures contracts were re-enabled. So that's the reason that the volume is going to be very light on the day. So when you're looking at the daily charts, don't be surprised to see this volume anomaly. It's only anomalous because the contracts weren't actually trading for many, many hours. And that's the reason why. Just got the 5-minute chart up here as a nice example of VPA in action in terms of a rally. You can see it here. We had a good dose of volume coming in. Nice move to the downside, then we get the reversal. This looks okay, then this one looks really weak. Why is it weak? Because we've got far more volume than was driven in here, and we've actually got a narrower price spread, and we've got a wick to the upper body. So it's not telling you loud and clear that it's going to reverse immediately, but it's telling you that's weakness. It's a rally. It's not a rally on weakness, it's a rally on selling into, by the big operators selling into weakness. So in other words, they're selling out here, there's more volume being forced into the market, into a very, very weak market. The market tries to rally, it's not going to go very far because there's so much selling pressure now in the market. And that's the reason you've got high volume, relatively narrow spread candle, wick to the upper body. The next one really just confirms that we've got weakness, decent volume under that, and down we go. So it's just a very simple, quick example of intraday VPA in action, if you will. Similar sort of thing. This is the NQ. Oops, sorry. Let's maximize that one. There we go. This is the NQ on 5 minutes. Exactly the same sort of principles. Ton of volume coming in. Weakness signaled. More weakness signal here, and down we go again. And pretty much the same on the ES as well. There we go. Lots of volume coming in. Obviously, the volume over here is huge. This is the market getting underway, all the traders getting back into the market. We had the strong rally, and now we're seeing that a reversal coming back into shape, and on we go down on a widespread candle on the day. But this is the volume. Look how low the volume is down here, and that's the reason why. In terms of indices, fantastic two-way price action on the indices. We go into the, where are we? Here we are, currency charts in multiple time frames. This is what we're seeing at the moment. They're not all the same across the yen complex. I'll just pop this up full size, things see it better. This is the volume that's coming in on the daily candle. You may not be able to see it, but this is how far the candle goes to where my cursor is. So it's between 64 and it's about 64.5 here. So it's been a huge rally, but an absolute monster amount of volume. What that means is that there will be a rally taking place at some point, assuming this candle closes more or less in the current condition that it's in. It may well, the market may well collapse again. Probably unlikely given we're now 6:30, but you know, all things are possible in the current environment. But if the candle closes with this deep wick to the lower body, this is the Aussie yen. I think the New Zealand yen's actually got a tighter spread on it, but equally deep wick to the lower body. That's what's shaping up across that particular complex, across the yen complex, and no surprise to see it. What's interesting at the moment is there was a rally. That rally has now weakened on the indices. In other words, the risk off is now dominating, but we're not seeing it quite so much in terms of the indices. The indices have rallied. They rallied with indices, but they've now, if you like, they're holding ground. They're treading water. They're not collapsing in line with the index market, which is always interesting. When market connections break or fracture, you know, it's always interesting to look at. We've had a lot of curious things with gold. I mean, one of the curious things which a lot of people are puzzled about with oil, let's be honest, is, well, if the oil price is so low, shouldn't that be good for business? And if you looked at it in those sorts of terms, the answer is, well, undoubtedly yes. If the cost of running a business is going to be, you know, through the floor, it's going to be much cheaper. Why is that not good for equities? And that's puzzling the markets at the moment. But a lot of this is managed by the big operators, managed by the insiders, the market makers. It's a panic reaction. And as we always say, you're likely to see the souffle effect. In other words, a pretty sharp reversal in due course. That's not to say it's going to happen tomorrow, but certainly these deep wicks, this is the Aussie yen. If I flick this onto the New Zealand yen, go and have a look at that one. There we go. Again, here you can see the depth of the wick more clearly. Comes down here, didn't quite get down to 61, but pretty close to it. We're now back at 64.95 and looking to push higher. But look at the volume. When you look at the volume and you really compare it with, this is the selling pressure that was coming in. Now we've got this extreme volume. This isn't even ultra high, this is extreme. So we've got extreme volume coming in. It's very similar, if you remember back to the flash crash, which we had, I think, it wasn't in March, I think it was in January last year, so 12, 14 months ago. Pretty similar sort of thing there. Massive reaction in the market, big moves in terms of pip count and just range basically, but a ton of volume coming in. And when these days occur, not only are they great trading days, but they're also indicative. They also give very strong signals of, as Anna said, what is going to happen next in this market. And when you get these big moves and you get these extreme volumes coming in, you can be assured that what is going on here, you know, there's very strong buying going on in here. It doesn't mean that the market is just going to V-shaped rally and roar all the way back up again. What it does mean is there's very strong buying coming in under this candle. The next few days, there may well be more of these, repeat of this, although the market has now got used to the fact that oil is at whatever it is, $33, $34 a barrel. It's collapsed out of sight. They know the reasons why, etc., etc. So what we like to see is certainly a reversal. And if you're looking at this from a longer perspective, then you're looking at buying opportunities. They have not arrived yet in terms of equity markets, but in terms of equities, again, it's a similar sort of process. What you're looking for is a buying climax, lots of volume, this sort of price action, the congestion phase to follow, and then the reversal coming out of that into a bullish trend, probably with some low volume tests to follow, and then into the reversal, into the bullish trend, and on up we go again as the markets recover, which inevitably they always do. This is extremely painful times for investors, of course, but as a trader, you know, you don't really care, you just want to be on the right side of the market. That's on the New Zealand yen. Let's have a look at the pound yen. That's a little bit different. It's had a more muted reaction, hasn't got the same depth of wick, still got a wick, still got a ton of volume coming in under there, but certainly not to the same extent as for the Aussie and the New Zealand. Let's have a look at the euro yen. Pop that one up. And similar sort of picture for euro yen as well. Again, body, wick, but not as extreme as on the New Zealand and as on the Aussie. Let's go back onto, let's go and have a quick look at oil. Let's triggered all this. As Anna said, the post went up on Friday. It came as a surprise to see quite how far it had gone, but there it is. All that way down. Again, you've got the wick to the lower body, although it's not, we have got a wick to the upper side as well. So this could well develop into a doji, which wouldn't be a great surprise. But again, you've got extreme volume coming into the market. This is not going to rally straight off the bat for obvious reasons. because this is not just about fundamental, this is about technical, and this is about politics. The politics of Russia and OPEC and everything else, which is always a dominant factor in terms of trading oil. It's just a fact of life. But in terms of the price action, the question is, will oil go any lower? I think it's highly unlikely. It's not going to collapse out of sight. It's probably going to trade around this range for a while before it actually recovers. But again, volume will tell you when and where is the buying opportunity. If you're intraday or maybe longer term, you'll see it clearly on the chart. You'll see more of this sort of price action again to the downside, more buying coming in. You'll see the evaporation of the selling pressure. In other words, you'll see price action moving in the same range where the selling is not as heavy as it was maybe a few days before or a few weeks before. And it's another signal, if you will, of when a market is preparing to congest and then reverse, because once all that selling has been absorbed, it's a little bit like a sponge. You pass the sponge once, it doesn't pick up all the spill that you have to go through 2, 3, 4 times maybe to pick it all up. And that's when the market has absorbed all that selling pressure, which is extreme right now. It cannot be absorbed. It's very unlikely to be absorbed in one hit. So it takes time and effort. The analogy we always use is of the oil tanker. You switch an oil tanker's engines off and it will continue under its own momentum for several miles. The market is much the same. When it has this sort of momentum, particularly to the downside, this is not a market you can just say, right, that's it, I've absorbed all the selling pressure. Whoever it is, however many market makers there are, big operators, there is still heavy selling pressure coming into that market, and it takes time to absorb and clear away. Intraday, plenty of trading opportunities, even late into the session as we pretty much are here. You can see I've got the 3-minute, the 5-minute, and the 10-minute strung across the top. Trend monitors flashing red right the way through, so it just gives you the confidence to hold the trade. Nice bit of weakness coming in here. Tried to rally, good volume under there. No chance, not going anywhere. And we carry on to the downside. Over onto the 10-minute. There we go. Just have a quick look at that one. Ton of volume coming in under this candle. Got a doji candle, more weakness. We've got support and resistance coming into play. This is on the accumulation distribution indicator. We've got a low volume node here at 3050, so if we get down to 3050, it's going to move through there pretty quickly, but then you've got a platform of potential support in below it, which may hold it up for the time being. Not that strong. The wider the line, basically, or the thicker the dashed line or the solid line, whichever you prefer on the indicator, the thicker it is, it's telling you basically that is a strong area. So the thicker the line, the stronger that region of support or resistance is. So for example, these levels up here, these have only been tested once, as you can see, whereas this one up here, this has been tested 3 times, so that's much stronger. This has been tested 5 times, so that's pretty strong. This is 4, etc., etc. It just gives you a heads up in terms of support and resistance, which is a key plank of the volume price analysis, supported by the indicators, of course. You can see here the trend monitor has been pretty bearish. This is, if you're comfortable trading in these markets where you've got volatile price action, these are the markets where you do make a lot of money, but you have to be brave. Let's face it, it's not everyone's cup of tea. Some traders don't like trading these markets. They prefer more measured price action, which is perfectly understandable. But rest assured, these sorts of days don't come along very often. We have been, I was going to use the word blessed, and we have in a way in the last couple of weeks. We have had price action that has moved the markets very, very rapidly on an intraday basis, which has made trading an absolute joy, a pleasure to be in there. Yes, it can be a little bit scary if you're not used to the speed, but for seasoned traders, these are the days that they make their money, I can assure you. And having spoken to a lot of floor traders over the years, for 320 days of the year, maybe it's lunchbox money. It's making and losing, and you're coming out sort of flat all the time. And then you maybe have 20 or 30 days in the year when you make an absolute killing in the market, and that's basically how it operates. And I'm not saying it has to be that way, but when these days come along, and I've said it many times before, these are money days. They are days to make money, to be in the markets trading actively. And loading up, whether you're scaling in or whether you're scaling out, just get in there and make money. It doesn't matter what you're trading. If you're trading Forex, fantastic. If you want to trade the indices, the principles are exactly the same. Let's just head back over to, let's go and have a quick look at, where are we? Let's have a look at the tick charts. Let's have a look at the tick charts on indices. Not sure which one I've got here, YM. Okay, I've got the YM set up here. Exactly the same principles. This is on the tick speedometer on the left here. This delivers the optimal tick settings when you're trading tick charts. And the beauty of tick charts is it takes away the issue of time. So you see raw momentum revealed on a tick chart, which you never see. I'm just going to ease it out a little bit. There we go. Which you never see on a time-based chart. On a tick chart, it's completely independent of time. In other words, each of these candles, I'm just going to change this one. This has slowed down a little bit. This had on 610 earlier on, so let's change that over to 377. The problem most traders have with tick charts is they never know what to set them to. And it's all guesswork, and well, I think, you know, somebody said this and somebody said that. I'll leave that one where it is for the time being. It was running at 987. It's guesswork, and for us it's not. We have the tick speedometer over here, which delivers these figures automatically for us. This is real time, so this is constantly changing as you would expect. It's also giving us a heads up in terms of the tick activity, whether we are trading in active markets or whether the market is a little flat. You can see where it's gone into red here. This is on 2 minute, this is on 3 minutes. So these are set up 1 minute, 2 minute, 3 minute. And that delivers the optimal tick setting for any particular instrument you apply. And you can apply all the other indicators, of course, as well. You've got trend monitor, got the VPOC here as well. And in addition to that, what it also gives you is an opportunity to apply volume price analysis, because you've got the linear relationship here between volume and price, which is giving you a heads up. So you're having the double advantage, if you will, of trading volume price analysis using this mechanism over here, but you're actually trading on a tick chart, which gives you momentum, which you never see on a time-based chart. It's just a great way to trade, and it's exactly the same principle. We use 3 of these, or I've actually got 4 here. Typically I use 3 or 4. Nice little rally going on. This is on 15 second. This is on the time-based chart, and these are the 3 tick charts equivalents. So you can see what's going on. So you can apply VPA analysis to this particular chart here on the top left, and then you can trade off these on the tick activity over here. You can see this little rally going on. I'll just pull that out full size. I love the 15-second chart. Again, it may not be everyone's cup of tea, but it just gives me an instant heads up on what is coming up at me. If I'm scalping on 1, 2, 3, 4 minute time frames, it just gives me a visual, very, very quick visual of what is going on, really as close as I want to be to the market. 15 seconds is pretty close. Trend monitor's transition here, you can see. Got a decent up candle here, but the volume here looks a little bit thin. Now we've got a bit of weakness coming in here. We've got a wick to the upper body. We've hit some resistance here on this blue dashed line. So we're hitting some resistance on the accumulation. So we're expecting the market to reverse. We've got a doji, and now we're seeing the reversal in place. We've got rising volume coming in. Now we're seeing the reaction lower. And that's all really triggered of this particular candle, which doesn't look right. The reason it doesn't look right is because the volume is not in agreement with it. It's too lightweight. If that market was going to go that fast, and you can eyeball across the chart here to get some idea. We haven't actually got one here. I've got one here. That's got volume there. There's more volume in there, but there's less volume in here. This volume just doesn't look right. It looks too lightweight, and that's exactly what it proved to be. We then got the volume falling away, weakness coming in, doji candle, and down we go. Now we're coming back down to the volume point of control. We just actually dropped down. The volume point of control moves the whole time. It moves according to the amount of volume that's sitting, the maximum amount of volume that's sitting in any particular region. And the yellow dashed line is actually the pivot. It's the fulcrum. It is actually the volume point of control itself. So that is the fulcrum around which the market then rotates, if you will. You can think of it as a seesaw, where you've got 2 equally weighted people on the seesaw, so it's not going to move. Once a heavier person gets on one side, then the market will move, because it has either bullish sentiment or bearish sentiment to drive it. And you'll see that reflected in volume. Excuse me. Just see how this develops. But that's why I like using this particular time frame, because if you're a scalping trader, you'll see it immediately. The volume relationship didn't look right. The price actions giving you a certain amount of information, but it's the volume. It was the volume in that candle. It just didn't look right, didn't sit right. We've now got the trend monitor starting to transition out of that little bullish rally. Now we're transitioning into bearish. And obviously what you've got to consider all the time is that what you're seeing on that particular chart is really just a microcosm of what is going on across all the other time frames, from minutes through to hours and days. These are just tiny little reactions on an intraday basis. Now what we're seeing is the opposite. We've seen the selling pressure come in, but the selling's not very strong. You can see it here. We have the selling under here, which is fine. But then what happens to the selling pressure? Well, it falls away. So you've got falling price and you've got falling volume. Well, that's not going to go very far, because if it were a real selling pressure situation, then this should be rising and this would be falling, and it hasn't. It's all fallen away. Now we're starting to see the reaction again. Volume still looks a bit lightweight, but we've got to bear in mind we are coming towards the end of this session, because the clocks have gone back over the, is it back or forward in America? I can't remember now. Forward. So we're actually running an hour earlier than we would normally do in terms of market time. Now we're seeing the rally take place again, moving up through a low volume node, which is fine. We've got decent volume over here, moving over onto the 1 minute now. This is on the 1 minute tick speedometer. Got nice volume under this candle. We're seeing rising volume, rising price, which is what we want to see, so that's good. Seeing the nice rally develop. Broken through this region here on this 377 tick chart and moving on upwards. Let's just go back onto the time-based charts for a moment, which I haven't got there, but we'll go down here. There we go. This is just the 5 minutes across all the markets. So I just want to see what's going on. And whenever you're trading the indices, it's always a good idea to have all three up. They will generally validate one another. Pretty much they will be doing what each of them is doing in terms of the price action. But sometimes you do get divergence, and it gives you a heads up as to opportunities that are developing. You'll see two indices maybe leading one more strongly, or one is leading very strongly and the other two are rather laggard. You see that quite frequently with the NQ. You'll see the NQ reacting very strongly and maybe not so strongly in the YM, or maybe not so strongly in the ES. It just gives you a sense of momentum and the opportunities for those laggard indices to jump in and be drawn along by a leading index of the three. And obviously what we're looking for now, and what the markets will be looking for, is reversals, and that will be dictated by volume. When we see the big volume coming in, the problem we've got at the moment is this: we can't actually assess this particular candle at the moment, but then there's a tiny wick to the bottom side anyway, so it's not that critical. What we need to see tomorrow is any reaction that comes in and the amount of volume that's associated with it in any uptrend. But it's interesting that the Aussie and the New Zealand yen, in fact, one I didn't, let me just go and have a look at the CAD yen. Obviously that's heavily influenced by oil. Oh, sorry, didn't mean to go there for a moment. Let's just go back. Here we are. Right, let's just put let's go to the CAD yen. There we go. Obviously this has had a double whammy, if you like. Let's put that up full size. It's had the double whammy of oil, and it's also had the double whammy of risk. But it's actually holding up reasonably well considering the extent of the sell-off in oil. It hasn't been absolutely trashed, but again, you've got extreme volume. The wick depth is down below 74, so it's a decent wick to the lower body. There'll be lots of triggers going on. Expect to see that congest probably at that region before we get any reversal. But again, the extent of the volume under that tells you that there is a large amount of buying going in there. Yes, there's heavy selling, and there has been heavy selling, but provided it holds up in that particular shape with a decent wick to the lower body, then you can assume that there is buying coming in, and we'll continue to buy in if we see more of those over the next few days and a consequent rally in due course. Just go up onto the intraday charts. Nice example there of the volatility trigger. This is triggered when the price action moves outside the average true range. It's just classical trap territory. You'll see it a lot at the open. of markets at session crossovers and so on and so forth. 8 or 9 times out of 10, what you're expecting from that maneuver is that the market makers or the big operators participating, the market moves rapidly. The volatility trigger arrives because it is looking at price action outside the average true range. In other words, what is the norm for a 3-minute chart on the CAD yen? This has moved outside that particular range. It's triggered. It's telling you instantly that the market makers are participating in here, and therefore there's going to be the possibility of either a full-blown reversal or at the very least congestion. That's what you're expecting when you get a volatility trigger like that. And the reason it's so powerful is very, very simple. It's because it triggers the fear of missing out. The fear of missing out is when the market moves rapidly. When it moves, jumps in one direction or another, your emotional response, and I would say everybody has this response, no matter how many times you see it, no matter how many years you've been trading, your initial response is to get in. I don't want to miss out, I want to get in. That's your response. We have it, I have it, Anna has it, we all have it. You can't avoid it, you have to manage it. And that's why it's so powerful. Your natural reaction will be to jump in, don't want to miss out on some easy, quick profits, and bang, the market either goes into congestion and screws you on emotion, because once you're in a position and you're in a congestion phase, then time is a big enemy, because the longer you're stuck there, the more your uncertainty rises and you'll either get stopped out or you'll probably close out because you're not sure anymore. And that's the power of it. In this case, it just reversed straight back down again. It's just a very simple indicator, but boy, oh boy, is it powerful. If you're in a position and it triggers, my advice is always close out, take your profit off the table. If you've got profit, if you're in a loss, that's a different scenario. But if you've got profit on the table and it goes in your favor, close out, that's it. Just sit on your hands, wait until it clears. Once it's clear, if it was going to carry on up, if it clears the top of the candle and it carries on up with maybe another up candle, that's fine. You're away from that volatility region. Otherwise, it's just a question of sitting and waiting for it to play out. There's nothing to say this won't actually go up in the fullness of time, but you really want to, you'd probably be stopped out anyway if you're an intraday trader with a move like that. But if you were maybe trading this longer term, you know, you might escape on this, you might sit there and wait, but it's the pressure of time which then comes into play. Let's just go back and see what's going on the indices. Seeing these tiny rallies go on at the moment. But boy, oh boy, they're going to be weak for a while. And as we said on the post last week, there's going to be a lot more of this before the markets calm. Hopefully by the end of the week, probably by the end of the week, they will have calmed and the volatility will have drained away, and maybe we'll be back to some more measured price action. But from a trading perspective, you know, volatility is great.
Well, you should bring the VIX up, darling. It's up to 55.
Have you got the VIX over there?
Yeah, I have actually.
What are you up to, 55?
Up to 55.
Yeah, the VIX is at 55, which I have to say is not, what was the highest? Okay. Let's go back to oil. Just Anna's sort of having a quick look at the VIX. There we are. Oil's trying to rally a little bit.
But it's nothing like it was in 2008 when we went to 80.
Yeah, went to 80 something in 2008. So it's 88. So 90. I thought it was higher than that. Okay, it's 90. So you just have to watch the VIX. The VIX has a chart, has an intraday chart. If you're trading on anything with sentiment, then you should have the VIX up, because on intraday base, you can have it on 1 minute, 3 minute, 5 minute, 2 minute, whatever. Exactly the same principles apply. Just give you another variant. And that's why full-time traders will have a lot of screens up, because there's a lot of information that could be gleaned from the options markets, from bonds and bond yields, bond prices and bond yields. You know, it all hangs together. Yes, they do break down from time to time. There's no question that some market relationships do break down. Certainly, there's been some interesting disconnect on gold, which I'm sure you've seen over the last few weeks. But things like bonds and bond yields generally do not. They are pretty consistent. Can I pass back to you for a moment, Di? Oh, is it what's the time? Oh, 7 o'clock. Blimey. Any questions? Hello, Fabio from Brazil. Welcome from Brazil, Fabio. Sorry, I just opened my chat box there. Yeah, let me just go back onto. Let's just have a quick look at the yen pairs again. Oh, sorry. Yes, I went onto the array for a moment there. This is on 3-minute, 5-minute, and 15-minute. This just gives you several pieces of information on a single indicator. It gives you sentiment towards a pair. So, for example, if we want to isolate out, let's see what's going on in terms of the euro. Click that off on the euro. There's quite a decent amount of buying of the euro going on at the moment. The strongest is Euro New Zealand, certainly on 3, but you can see here Euro Aussie, Euro New Zealand. The other point about it is that not only will it give you a sense of strength of trend of those particular pairs, but it also gives you a sense of whether the market is universally buying the euro or whether there are certain pairs which are not following that particular trend. In other words, if you're trading any of these right now, aside from possibly the yen and the Swiss, which, let's face it, are being dictated by risk flows at the moment, all these others, if you were trading in here, you're pretty much universal in terms of buying of the euro. Same here. Again, it's yen and Swiss, Swiss and yen. You know, that's to be expected. In a day like today, you're going to see heavy flows into safe haven currencies like the yen and the Swiss franc. So they are slightly going to be out of kilter with everything else. But generally speaking, if you're trading the euro right now, euro Aussie, euro New Zealand, euro CAD, they are moving in the same direction. So everyone is pretty much buying euro universally on these faster time frames. That's not to say they're doing it on the day, but that's certainly on an intraday basis. That's what's going on right now. The other thing it also does is it gives you a heads up in terms of whether a currency pair, as opposed to a currency per se on the currency strength indicator, whether a currency pair is either oversold or overbought. When they come up with these brackets to either side, then that is telling you that it's approaching a region. It's not actually at an oversold or overbought region. So we've got brackets all the way down here, but the New Zealand Swiss, certainly as far as the 3 minutes concerned anyway, that is at an oversold or could be considered at an oversold condition. It's not a signal to take the trade, but it's certainly a signal to go and have a look at that particular chart. You'd have a look at the volume relationship, and then you make a judgment based on that. So it's giving you heads up to a lot of information. Just click those back on again. Yep, I'm just going to pass back to Anna. So I'll switch off for the moment.